a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about ETFs that protect from inflation, or at least try to protect from inflation. So we know that inflation is one of the biggest concerns for investors lately, and the CPI index, the report was released last week, that jumped to a 7.9% annual rate in February, and that this was the highest rate since January of 1982, so more than 40 years. And gasoline, housing, and food prices were the biggest contributors to this rise in index. And this report was for the month of February, as I mentioned, and we know that the war has escalated in the past about 2.5 weeks, and that has further pushed the prices of energy and other commodities higher. So that was not reflected in the CPI report. And we know that we have talked about Russia and Ukraine being among the biggest producers of oil, natural gas, food commodities, metals, and that is why the prices of those commodities will have gone higher, and they will further raise transportation costs, manufacturing costs, and this war and the conflict, this also disrupts global shipping networks. So that could also put pressure on inflation. And then we have seen a renewed resurgence in COVID cases in China. And because China follows a zero tolerance policy, they have had many pandemic lockdowns in the country lately, and which is further adding to disruptions of supply chains. And lastly, the labor market in the US has been recovering very fast. It's very tight. We have seen that number of jobs has open vacancies has been rising, and wages has been rising. So wage inflation is also picking up. So before the war started, many experts had predicted that inflation would cool off in spring because supply chains would improve after these pandemic-driven disruptions. But now it seems that inflation may persist for longer. So we have seen a number of new ETFs also launch lately, which want to protect, which are intended to protect from inflation. We take a look at three ETFs which have been around for at least a year. I haven't included the latest ones, which have very little performance history and low assets under management. So let's take a look at these three ETFs by going to the quote page on Zacks.com. So the first one I'm highlighting is by Horizon Kinetics. The ticker symbol is INFL. This launched last year when concerns regarding inflation started emerging. So this quickly gathered more than $1 billion in assets, has $1.2 billion now, charges 85 basis points, and is actively managed. Let's go to the quote page on Zacks.com. I did a podcast with the manager too, so you can listen to the podcast. You can go to the web page of the ETF and see what it does and what it holds. So it invests in companies that are expected to benefit from rising prices, and it basically these are companies with asset light models. So if you look at the holdings, these are not the typical companies that you hold in your portfolio. So you do get some diversification benefit by investing in the CTF. For example, Texas Pacific Land Corporation, Archer Daniels, Prairie Sky, Viper Energy, Franco, New Corp. These are the top holdings in this ETF. The second one I'm highlighting is by Fidelity. This has been around for a couple of years. Fidelity stocks for inflation ETF, ticker symbol FCPI. This holds companies that are inflation sensitive, has a market cap weighting scheme. This is cheapest of the three that we are discussing today, 29 basis points, and has 181 million in assets. So again, you can go to the quote page on Zacks.com, and from there, the external homepage, Fidelity's webpage for this ETF. So this, as I mentioned, large and mid-cap companies with attractive valuations, high quality profiles, positive momentum, and industries that tend to outperform in inflationary environment. I looked at the holdings. These are companies which have the pricing power, so they may be able to increase their prices as inflation climbs. So Apple, Microsoft, New Corp, Marathon Oil, PDC Energy, these are the top holdings in this ETF. The third one I'm highlighting is actually an ETF of ETFs and actively managed. It's by VanEck. The ticker symbol is RAAX. This has 53 million in assets and 74 basis points expense ratio. So again, you can go to the quote page, web page, using the link from the quote page, and provides exposure to inflation fighting assets and a wide variety of these assets. So as I mentioned, it's an ETF of ETFs. So it holds VanEck Energy ETF, Gold Miners ETF, Energy Select Spider ETF, then Global Infrastructure ETF, Oil and Gas ETF, Agribusiness ETF, Oil Services ETF. So all kinds of ETFs from sectors and industries, even Bitcoin, which is supposed to be an inflation hedge, though it has not actually been an inflation hedge from the recent performance, it appears. But this is what the ETF holds. Now, on this slide, I have the comparative performance versus the S&P 500 index over the past year. So all the three ETFs had returns between 18 to 20%, whereas the S&P 500 index is down about 8% over the past year. On the last slide, I have the comparative performance this year. Now, because the VanEck product has a lot of exposure to energy and other commodities, and we know that energy prices have surged, particularly because of the war. So that is why that is the best performer this year. This year it is up about 8%. The Horizons inflation ETF is up about 3%, and the Fidelity down about 7%, whereas the S&P 500 index is down about 12% this year. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer, and also make sure to subscribe to our videos, and I'll see you next week.